HIM stock continue to get hammered on increased interest rate fears, and we have to talk about today what do higher interest rate means for stocks like HIMS and other growth stocks. Should you be worried as an HIMS investor? Should you do anything different with your long-term strategy? And how much lower can HIMS price go is the question here today. So let's get straight into it. If you've been an investor in HIMS for the past year, you have seen the stock IPOing and then going from an all-time high of 25 to a recent all-time low here today, going down 82% to a new price of $4.47. So just when it hit $5 and you thought it couldn't go any lower, it's already insanely priced. Yeah, guess what? It dropped another 20% from there. So we have to talk about interest rates. Obviously, the market is completely scared about it. Why does it affect growth stocks in particular? So we're going to look at that. But we're also going to look at the broader market, some macro factors of what does history tell us whenever there was an increase or decrease in interest rates, and how did it affect the stock market. So it's definitely interesting to see. So the first question, why does it affect growth stocks so much more than other stocks like a Coca-Cola or like an Apple, for instance? So this has everything to do with what's so-called the DCF, the discounted cash flow model. And as the name suggests, so basically you have cash flow coming in that model from year 1 to 5, and that cash flow gets summed up and discounted or taken down by a certain interest or discount rate to a present value. Here's just an example. This is not HIMS related, but this is an example of a discounted cash flow model. So you see that, in year 1 they make $1,000, up to year 5 making $1,900. So most of the so this is a very evenly distributed cash flow with an even growth. But what happens to a company like HIMS? There would be potentially no cash flow, no positive cash flow in year 1, 2, maybe even in year 3. But as the company expands and really grows and has a lot of marketing and selling expenses on purpose to brand, to create a global brand, get their name out there and grow their business. So on purposely there will be no cash flow in the first few years, and then most of this cash flow, when you do a cash flow model like this, will be sitting in the back end of that model. And what that means is basically the higher the number later on, which is usually in line with growth stocks, because they are only supposed to or expected to make profit later on in the cycle. So the higher the number later on, the lower the current price, based on the way it's mathematically working here with that discount or interest rate. So if the interest rate gets higher, discount rates usually get adjusted, and basically the higher the number here is, the lower the present value will be. So the higher the interest rate, the lower the present value of all the future cash flows, and that present value you simply just divide by the numbers of shares and you get the share price. So this is how it works. So this is why stocks like HIMS, stocks like T-Docs, stocks like Square, where sort of the future potential is much higher than what there is in the present day, those get heavily discounted on higher interest rates. So this is why valuations have been coming down, now also start to come down for even bigger tech stocks, even though they have positive cash flow now. It's just the way it works from a mathematical perspective. But if you think about it, this is a mathematical operation. What's the actual impact on HIMS of higher interest rates, from a business perspective? So if you think about a business, we have your assets. So this is a balance sheet of HIMS and HERS, the last quarter balance sheet from the 30th of September. If you think about the business, they have assets, they have cash, they have some intangible assets as well, like brand name and stuff like that. But then on the other side, they have liabilities, which they pay their invoices and their suppliers, and they have sort of long-term debt, which they usually take from a bank. So as a company, you can either raise equity, you can raise shares and capital to get more money, or you can go to a bank and get a loan. So basically, if you go to a bank and get a loan, the later you do that in this cycle, when the interest rate goes up, the higher your interest rate expense, which then says, if you have a lot of loan and you have a lot of and that interest expense is increased, it basically your profitability takes a hit, your net income will be lower, your cash flow will be lower because you're paying more to the bank. This is the rationale behind why does an interest rate actually matter to a business. But look at the case of HIMS here. We can see that there's only really a $1.2 million long-term liability, which I assume that's some sort of like a form of a loan, but on which they actually don't really pay any interest rate, as we will see soon. But even if this was the loan, look at just the cash balance alone. It's almost $65 million at the moment, with another short-term investments of $188 million. So they could pay off all their long-term liabilities, plus even any future debt that they might take, although they don't really have, they don't really have to do that because they could just raise additional capital, or they actually at the moment have enough cash, I would say, to expand and fund those higher marketing expenses. Because when you look at the P&L, the profit and loss statement, what would happen is if they took out additional loan, then that interest rate expense, which is zero at the moment, that will go up and basically decrease their profitability, which is at the moment anyways at a loss. But let's say a few years out, let's say in 3-4 years, HIMS is taking out a loan, and we think that those marketing and selling expenses will be lower. So then we have, gross profit minus interest expense equals net profit. So then that net profit obviously would decrease, but even if they took out a loan of a few $100 million or whatever it is, maybe not $100 million, but let's say a few 10-20 million, look at that gross margin. The gross margin at the moment, so out of $74 million, $55 million remaining. We're looking at an over 70% gross margin. So they could easily afford to have interest expense in there, even if they wanted to. But I don't think they have it. It's not necessary for them, which is the beauty of the business. So they have high gross margins. They don't need external loans from banks to fund their business. So an interest rate increase basically doesn't affect HIMS at all at this stage. What is actually more of a concern from my perspective is more like something like high interest, high marketing and selling expenses. So if inflation doesn't get controlled, this expense will actually increase even more and will lead to even a higher loss. So by the Fed raising interest rates to try to control the inflation rate, we're actually doing something good for HIMS. This is my point of view of that, and and I think the other issue that you might have in future is maybe if they raise too much capital, then you have a share dilution issue, which obviously in every type of growth company, that's a kind of an issue to consider. What's the share dilution percentage? At the moment, it's not that much. It's around 5% from memory. But yeah, that's definitely something to keep an eye on. So we just figured out that we know why growth stocks like HIMS have been decreasing, but we also looked at HIMS itself as an individual company from a micro perspective, and we noticed it is not an issue for HIMS. Interest rate pretty much doesn't affect their business. So this is definitely good to know for investors. Then I found this table, which I thought it's pretty interesting to share. This basically shows the stock performance of the Dow Jones, S&P 500, and Nasdaq, which are three US indices, stock indices. Shows the performance of them over a period of time when the Fed either cut interest rates or hiked interest rates. And what we see here is, let's say they hike. So now we're in that phase of, we're at the end of the cut cycle, and we expect a new rate hike cycle to begin. And you can see that can vary from almost just 1 year until the last one, which was 11 years after the global financial crisis. So yeah, they have varying time frames, and but you also see that it always comes and goes. So they always kind of, you know, come hand in hand. So once that starts, once the economy runs too hot, the rates are hiked. Once it slows down, the rates are lowered. So it's a constant balance on which the Fed tries to keep the inflation within a, you know, 1 to 3% range. And this is just how the economy works. And we've seen here that we can see that the last rate hike actually was from 2008, the global financial crisis, so right from basically from the dip. Yeah. So this is just what happens right now. We're in this dip mode. The last rate hike cycle lasted 11 years, and the S&P was in the longest bull market ever. So actually exactly the opposite of what people are afraid of right now happened after the last, or during the last rate hike cycle. So this is kind of counterintuitive, because you think that, oh my god, rates are getting higher, valuations go down, I have to sell. But what people don't consider is, if the rates are getting hiked and hiked and hiked higher, that basically indicates that because of, you know, higher productivity due to technology and other factors, GDP and the economy is doing very well. So the more you need to hike your interest rates, the better basically your economy is running. Because what they do is, by hiking the interest rates, they're trying to temper, they're trying to you know, slow down and prevent overheating of the economy. Basically that's what they're doing right now, because the economy is running so hot, inflation gets out of control. They're raising the interest rates to counter effect that increased inflation. But as you can see, for sort of us as investors, it wouldn't even have made a difference, and it was actually the best performing period of all times. And if you look at the other periods, when, okay, here was a cut cycle, S&P did well, 44%. Here was a raise cycle for 1 year, and there was a 30% upwards here for the S&P. So what does that really mean? It means that it doesn't matter if you invest, and that's what we're gonna come to as my last point. If you invest into individual good companies and you've done your research, then it doesn't really matter what the interest rate is doing, because over a longer period of time, your stock, your company will outperform anyways, and will basically will do its own business. Won't be affected by whatever is happening on a macro level. It might dip for a while, but it eventually comes back even stronger and will outperform the market. So, but from a generic perspective, we see that rate hikes or rate cuts might have a temporary effect on the sentiment, but overall don't really change any of the return levels. So it seems to be quite random when there is a, you know, extraordinary year, and when there is a year that is not as good. But yeah, this is just an important, I thought this was a really, really cool table to see that it doesn't matter as much as people think, and that fear is just not justified. And then as a last point for today, I want to show you two examples of two companies. So basically we see this here from 1998 till today, all these different, 1989 till today, all these different rate hikes, rate cuts, and so on and so forth. So you would expect that the stock market would look like, oh my god, like crazy, all the time, up, down, up, down. When you look at the actual stock market, so I've got the S&P 500 here, which is, you know, pretty much 500 largest companies in the US. What have they done since 93? I mean, of course there are some dips here along the way, but overall you've outperformed everything, and you've just gone higher and higher over time. So even if you invested in the dot-com bubble, you were down 37% just to eventually recover. If you invested into the global financial crisis right at the peak, you would have been down 40 odd percent, but still up eventually. If you just had that long-term mind, and you know, if you just had that long-term mind, the long-term investor mind, which then basically says, whatever happens in the short term, I don't really care. I know what I own the quality. I'll just invest, hold, buy more, just wait, basically. I mean, Warren Buffett says, usually the most successful people are the most patient people that just sit it out. They know what they've bought, so they will just sit it out until it finally pays out. And then looking at two different companies from that period, so where do you, if you zoom out on Google stock like this, where is the significant dip, right? Like, of course, if you were in that moment where 2018, when also they announced some economic difficulties. Okay, they were 16% down in a few 4 months, but overall, if you zoom out from like multiple years perspective, you are not even, it wouldn't even affect you. And if you had invested before that little dip here would bring you from 100% return to 80% return to just eventually push even higher. Whereas if you invested in something like a Nokia, which was really, really hyped around the 2000s with their mobile phones, but then didn't catch up on the new trends and didn't stay relevant once the iPhone came out, then obviously you could have waited until today, more than 20 years, and you will still be down 92% since the all-time highs. So this just shows that you really need to know what you're buying and what story you're buying into. You need to analyze, you need to keep up to date with your company to say which stock is worth investing into and which stock is worth waiting for to recover and eventually really outperform the market. So as we saw that DCF model, it does show you a lower return with higher interest rates, or it does decrease the valuation, we should say, for higher interest rate. But if you outperform over a long term of time, like a Google stock, for instance, why would it matter that, okay, your valuation comes down in that moment, and then you might have a bad valuation in terms of, how it's calculated based on that model, and you have an overpriced stock or whatever, but then on the long term you would outperform the market. So that just shows that interest rate do matter, but only in the short to medium term on sort of the direction of the stocks. But then long term indices and stocks that are, from good companies will eventually outperform the market and will yield you massive returns if you just have the patience to sit it out and just ignore that whole, heat and stress about that crash and increased rates. And there's always something new coming up. There's always like the end of the world coming. And then if you think that the economy will be better in 10 years, then you have nothing to worry about, and you just have to sit it out, take that volatility, buy even more, and then So this is my update on whether interest rate affects HIMS or not. And I hope you found this one helpful. Let me know in the comments, and let me also know other stocks that you want me to cover in future. See you.